Hey, we're live. It's Lex and Traders Workshop. I've got my pals Jason and Mark with us. We're going to talk a little bit today about low volatility trading. We haven't had that in a while, so let's see what the guys have to say about this one. Stay tuned. Hola, welcome. Happy Easter, happy Passover. What's going on, boys?
Things are good. Looking forward to having Good Friday off tomorrow.
Do we have, wait, tomorrow? Yeah, we're off. The market's closed, except, Mark, you mentioned earlier, SPOOs are open for 45 minutes. Is that right?
Yeah, that's what Jason was saying. I guess there's a very brief morning session.
Okay. What's the point of that, Mark? I can't remember that from the old days.
Are they going to be open when the NFP numbers come out? I don't actually know myself.
Yeah, I don't know.
Jason?
So yes, they'll be open for 45 minutes through NFP, and then 45 minutes later, it's the futures market closes.
And that's it. Day's over.
Yes.
Okay. I get into my spring cleaning then after that. That's perfect.
You got to go to Good Friday. You got to go to Good Friday services, man. You're Catholic, right?
Yeah. I might go to that. Right. Not going to say anything, get anyone all upset. Not saying anything. Keeping that quiet.
Well, you got to count both because we get Good Friday on Friday, and then Easter Monday is also sort of a holiday. Like the European markets are going to be closed on Easter Monday. So we really got like a 4-day weekend, 4 days like snoozer for the markets.
Yeah, I'm gonna put all the furniture out for the season. That's what I'm gonna do. So that's my big chore tomorrow. Okay, so what's the markets doing? I think we have a little bit of a down open, nothing much, very mild. We've had quite a nice little rally here, right? Maybe as expected, with this nice little rally, we have probably going to some long gamma points. We're hammering this thing at a level. All of a sudden, we see VIX drop beneath the 20 handle, right? So where is that now? Is that in the teens? I'm assuming 19-ish and change. So, Mark, would we consider this lower volatility? I know it's not low because I've seen 8 on VIX before.
Oh, I've sold 12 vol and been thrilled, right? So I don't think this is exactly low, but compared to what we've, been in the mid-20s for the past 14 months, this is starting to feel like a relatively lower vol environment. And, I think we're seeing low vol and we're also seeing low volume. And those are feeding off each other.
Yeah, I check OCC composite volume every day, and you're right. So I think average for 2023 is around 46 million contracts a day, and we've been in the 38 range for the last few days, I think. So definitely under average for the last several days. So pretty typical.
Yeah, even open interest isn't building up the way it typically would be by the third week of expiration. We're right smack dab in the middle of a long expiration. We got a holiday weekend. Volumes are sluggish. Market's kind of drifting upwards. Not a lot of big news events coming up anytime soon. It's quiet times out there.
Yeah, definitely quiet times. So what do we do in this environment now? What's the prescription for low vol environments? There's got to be some sort of spreads we could kind of take advantage of. Jason, you can weigh in on some of the levels you're seeing on Voland.
Yeah.
What looks to be the kind of the little 2 bumper points downside, upside?
Well, I mean, right now we are in a lower volatility than we've been in a while, but we are still high. 19 vol is implying like about a 1% move per day, and we have not been getting 1% moves per day. I think like last Friday or something, we had a 1% move up, and that's been it for the past two and a half weeks. And so I've been, we have a lot of Vanna exposure underneath current price. I mean, do you want me to share my screen? I could share.
Yeah, I mean, it's $5 for you to share your screen. So just send it to me in the mail.
Okay.
I only take cash.
I'll take it away for the $5 charge of displaying Volans. How's that?
That's a good idea. That's a good idea.
So we're net zero. Here we go.
All right. Where is this thing? You don't have it up here now.
Yeah. Hold on. I'm sharing now.
Oh my gosh, you're killing me. All right, here it comes.
We were so prepared for this show. Um,
All right. So this is what? What are we looking at? Vanna?
so we're looking at Vanna.
Quick
You know,
explanation so we know long and short. So just give us the the elevator pitch version of what Vanna means, long and short.
Okay. So Vanna is the cross derivative between delta and vega. So or delta and implied volatility. So as implied volatility goes up, delta moves whether the option is is above price or below price in different ways. If you are long an option and it is out of the money below price, it's negative Vanna, and above price, it's positive Vanna. Okay. So that flipping of Vanna, though, and at 50 delta, Vanna is zero, no matter whether you're long, short, or whatever. Mm-hmm. And that Vanna flipping is what causes that magnet effect that most people attribute to gamma, but it's really a Vanna effect. So you kind of have to know what the Vanna outlook is. And so when you see a lot of positive Vanna below price, mm-hmm. then if implied volatility goes up, then that hedging has to accelerate, and you go, the price will go down a lot more than the implied volatility normal like correlation would imply. So mm-hmm. that's kind of what we're seeing. Although, and negative Vanna above would kind of have a slowing effect. So if implied volatility is dropping, and price usually goes up when implied volatility drops, it would be slower when you have negative Vanna above. So for the past couple weeks, or I guess past like 5 or 6 days, since last Thursday, I've had a short gamma call vertical mm-hmm. Around this area. Actually, it was around this area. It's around like 41.75, something like that. And the reason why is because we had a lot of negative Vanna above price, a lot at 4,200, which has since, I guess, expired. Mm-hmm. Yeah. And there was also that JPM quarterly expiration that threw things off a little bit. But we have a lot of implied volatility below here, positive, below mm-hmm. price in Vanna. So with implied volatility low and kind of getting these little explosions because of economic uncertainty or jobs reports or whatever, I did a bearish short call vertical. And I think now, I did it on Thursday and it went against me for a little while, but I think now it's about even, or it's up a little bit now. So, I'm just kind of riding the lazy river of short gamma for a little while. But usually when implied volatility is low, and I'm sure Marco will talk more about this, when implied volatility feels low, it's probably not low enough. Mm-hmm. And when implied volatility feels high, it's probably not high enough. A lot of people like to fade and rely on mean reversion for VIX or implied volatility. And that doesn't work up to, it doesn't work instantaneously. Mm-hmm. It's, that catching the falling knife thing. And so while 19 implied vol is low for the past year and a half, it is high for history and for realized vol.
Right. And you said 19 is roughly a 1% daily move. Is that what you said?
16 is 1%. So 19, I'd have to do the calculation. Yeah. It's like 1.15% per day. Is that right, Mark?
Yeah. That sounds right. Because the square root of 252 is like 15.87. That's why we get the 16. Right. Got it. All right. Excellent. Okay, Mark. Let's send in the prop trader perspective here.
I really like actually what Jason's talking about in terms of kind of picking the spots here, right? Because I think that's one of the difficult things in a low vol environment is that it might feel too low, but it's hard to be on either the long or the short side. So I think the hardest part is staying patient and picking your spots for where you really want to set up that trade. So I really like thinking about some of these, whether it's a Vanna level or whether it's the however you want to think about where you're picking your spots. I think low vol means it's time to be choosier about those spots because you're collecting less on your short trades. And to the point about realized vol, even when you're getting long, right, realized vol is significantly lower than, I don't have a number, but it's definitely, I guess we're realizing closer to like 13 or something compared to, that VIX reading of 18 or 19 now. So it can be dicey on either side. So be choosy is definitely my words of wisdom.
Yeah. So, Jason and Mark, here's what I'm thinking. Jason, you mentioned that 19 vol VIX is low, but probably not low enough for the moves we're getting for the realized
Right.
part of it. So it sounds like 19 vol is almost a sale, counterintuitive. Conversely, when vol is higher, implied volatility is higher, it's probably not high enough for the moves that we're seeing. So again, counterintuitively, you could buy premium at those levels. So, and I always struggle with this on my floor trading days, knowing how to position myself at lower volatility environments. It seems like you want to be long gamma, long some vega to take advantage of another mean reversion of implied volatility to a higher level. However, like you said, catching the falling knife or musical chairs, it feels painful when you're paying theta at those lower volatility numbers. Even though the prices are lower, it's still, you're still throwing theta out there all the time. So, as a result, what we tried to do, I think, Mark, is maybe set up some sort of time spread, calendar spread or diagonal, sell a little bit of front month, get a little vega in the back month in case you get another spike, but at least you're collecting something, granted, not as high as it used to be. What do you think about that stuff?
I think that's actually exactly what the market's doing. Like, one of the things I've noticed in terms of skew is that back month skew is actually starting to pick up a little bit more. As vol is coming in, though, that sort of 90-day skew level is rising relatively. So it's more the front, I guess, not the call side of the curve that's coming in as vol lessens. But that skew pricing is remaining there. So I think that's suggesting a front month sale, and especially on the put side, a down month or back month buy.
Back month buy, okay. And would you ever do that where the back month is an absolutely higher implied volatility than the front month? So you're buying a higher implied vol and selling a lower implied vol. I mean, I know I've done that before. It sounds like another thing you shouldn't do, but I know I've done that before.
Oh yeah, that can be totally reasonable. I mean, in some ways, it amounts to the cash premiums you're collecting too, and the absolute levels of that high level, right? If that relatively higher level is still cheap historically, that can be a very reasonable spread to put on and finance it in the ultra low realized short term.
Yeah. Okay. Good. Let me share. I'm gonna yell at myself for not sharing my screen.
Okay.
But let me show you something.
Sharing.
No, you don't have to stop. I just have to learn how to share. Of course, this ought to be fun too, right? Okay, I'm sharing. I'm probably sharing something weird.
We're so prepared.
I know, right?
Oh, look at that.
Okay, that's us. Okay, can you guys see this?
Yeah.
So this is, I think, Mark, this is what you just explained. So I know people can't figure out what the heck this looks like, but this is an implied forward volatility term structure. So any one of these colors is just a particular month. And what it's showing is that the front month being 0, and these are expirations going out in time. It's almost like a contango sort of environment, right? So these are lower implied volatilities near the front month, and they're curving upwards as time goes on, right? So that's exactly what we're seeing in the marketplace. Is that accurate? Mm-hmm. So this is a graphic representation of how that, and I use spiders just to get a market thing. So definitely looks like what we just talked. And then down below, what we have, let me take off this guy here to make it easier. So you see these are the term structures I've chosen up here. You can see them kind of lower up front, tailing back off, or up higher behind. This lower lines, the green and the red, these are implied lower boundary volatilities, what it should look like based on a heavy set of statistical analysis. Okay, and you can see the actual still much higher, okay, but they've converged in the front months up here, right? So they've come toward, and it's very rare that you see the lower boundary meet the actual in the marketplace. It's very rare that it happens, and it's just when that happens, vol's really low. Okay, so it's not obviously not there yet in the outer months, not even close. Inner months getting close. Now that could be something like, hey, we have Easter holiday coming up. We're going to miss a whole day tomorrow. And they've already started to build in this theta even before we open, or we're just opening now. So they're building in theta. They're going to put Saturday in here. They're going to put Sunday in here before you know it. And next thing you do, they're going to put Monday in. And it's going to look like it's really cheap volatility when it's really just days coming out, right?
Yeah. One thing I wanted to talk about a little bit too, when you said when implied volatility looks cheap, if you look at, your platform or whatever, and you see implied volatility on Monday at 13% at the first opportunity to trade after NFP report tomorrow, it looks cheap, but it isn't, because that theta is counting Friday, Saturday, and Sunday as part of the days. And it's not, and the other thing you were saying too, even though implied volatility feels low at 19, you just showed on your trade hawk that those out months are still way too low or way too high vol.
Yep.
It takes when you say reverts to the mean isn't what the mean is of the VIX or something like that over time.
Right.
The mean is the implied volatility meeting the realized volatility.
Yep.
So people are, there's some people out there buying UVXY or something like that, expecting it to bounce back to a, VIX to bounce back to a certain level. And in truth, the realized volatility is so low because even NFP reports or inflation reports are all expected. Yep. They're expected reports, and people kind of have things priced in and figured out a little bit better now than they did last June.
That's right.
So they're not volatility events anymore, and going short gamma, maybe a calendar spread or like a vertical or very wide condor perhaps for like 3-4 months out, that can yield you some decent money.
Yeah, no, I agree. So I'm going to give you a plug, Jason, and I'm going to ask Mark the answer. So here's the plug. All right. First of all, here's the question. Okay. How do you choose your strikes? Okay. And we'll finish up with this. We got a few minutes left here. How do you choose your strikes as to where you place your short? If you're doing this diagonal kind of sort of double diagonal, or you're doing a calendar, either one works. You have to be pretty clever on where you place your short strikes. And my answer is going to be, let's look at Volin. That's the plug, so that we can see where those levels exist, especially on the sticky longer gamma side to the upside, if it exists, and throw one a little higher than that on the short side. On the downside, it might be a little trickier, but you can also find a Vana level that might be a good, fulcrum point to pick your spot. Mark, when you and I did this, 100 years ago, or at least for me, 100 years ago, we didn't have this tool. There's no way, you just had to be intuitive about it and kind of put your finger up and say, I think this is good, or just take what's trading, right? But now you can choose levels based on some data and some stats to get us in a good spot. What do you guys think about that?
That's exactly what I do. I mean, that's kind of the basis of my trading. I look at particularly Vana levels, because implied volatility, it tends to be what I guess you could say it's a little less hedged than for market makers than gamma or something, or any of the other Greeks. I look at Vana, and I say right now in particular it's about 3850 to 3900 is very positive Vana. That may be a target if implied volatility does expand. So but if it doesn't expand, you have this really wide condor that you can put on for 3 months, 4 months. And even if something moves 1%, 2%, you have the negative Vana above, where to put the bearish leg of your condor. Yep. And you have the positive Vana below, where to hedge the downside. You can even put your other side out. So, I mean, you can have a wide berth of 300, 400 points, and at 19 at 19 VIX, you can get a decent return for that. You can get like a 20% return for that over 3 months, 4 months. Like, I wouldn't mind that for my portfolio.
No, it's good. Any thoughts, Mark?
Yeah, no, I think that's a great tool in terms of picking some levels. And I mean, the only other way that I think, it's sort of like putting your finger in the air. But if you think about like the cash value of a spread, right? Like that's always a really nice way to like say, hey, I want to put this on, well, not necessarily cash neutral, but I want my target return to be this. If I want my return over 3 months to be 4%, okay, how tight does that condor have to be? And that's sort of one of the ways I like reverse engineer that I'll think about, hey, what should my yield be? Where does those strike set? Does that feel good? Does that feel right to collect that much money, risk reward versus a move, or to pay that much for a move?
Yeah, right. I'll also plug somebody who's not here, because I use his tool quite a bit to help pick strikes as far as like value of options goes. Our boy Matt Amberson with Orats has that option picker, the option trade builder, and he finds like those values too. if you combine Voland with that tool, you can get some really great edge and return to risk.
Yeah, that's nice. I said that was going to be the last thing. This will be the last thing. One more thing. What do you think about this idea too? I'm just giving the audience some ideas on spreads. So Jason mentioned an iron condor, and let's say the front month thereabouts. So you could do iron condors, and you could do sort of a ratioed, back spread in back months, right? So we got a little Vega in the back months. We're paying for it by, consecutively rolling out iron condors in each of the months. Never short units anywhere. You're actually long units. So if you get a monster move up or down with your 2x1s or 3x1s in the back, you get value out of that to cover those massive moves should you get it. So I kind of like that spread. Again, it all depends on price and all that kind of good stuff and value. But what do you think?
When doing something like that, just avoid putting your long strikes right where Vanna spikes are, because that's where they tend to magnet. So if you put your long strikes at the Vanna spike, you'll end up, if an implied volatility moves up, you can end up losing money.
Yeah, right. Yeah, I kind of like that spread though. If you can make it work, because you have several weeklies to kind of bang condors out and take advantage of it, right?
Yeah.
So sooner or later you have that back spread for free. But
right.
Yeah, everything's free in this world. It's perfect. Free composites. All right, guys. Anything else?
No, I'll just say I like that trade a lot. I run a less complicated version of that as like a protection strategy that you pay for protection by financing the short term against it. So I think arbitraging, it's not arbitrage because, of course, there are all the different ways we can talk about how this trade goes wrong. But like taking advantage of that time differential, I think is tried and true.
Yeah, I agree. That's what I like to do in low volatility environments as well. So I think we're all more or less on the same page. Jason's got more tools than I do, but what can I say about that other than nice tool?
That's what she said. Okay.
It's a family show. My God, keep it clean, will you? All right. Got to run. Good to see you guys. Have a great holiday. We'll be back next Thursday, I believe. So good to see you and have a safe one. All right.
All right. Take it easy, Lex. See you, Mark.
Bye, guys.